Monday market update. I've got Matt Stancato here with Guild Mortgage Lending, and today we're going to be talking about some positives that will appear to be coming out of tariffs that should have been going into effect today. Probably won't be seeing those for another 48 hours, though. The effects of the tariffs.
There's a bunch of different things that are going on, and I might be appropriate that today is also April Fool's Day, that these tariffs go into effect, depending on which way you think about it. But the tariffs were announced to go into effect today. There is apparently a 48-hour reciprocal period where each side can look at their tariffs and decide if they want to make adjustments. The idea behind that, I think, is that hopefully the person with the bigger hurt from the tariffs going into effect will simply push their way right up to the deadline, and they say, never mind, guns down. And hopefully then at that point, the tariffs go away and we go back to a free trade situation. And that would be, I think, the ideal outcome. Now, whether or not that becomes the outcome is anybody's guess.
Everybody's guess. Absolutely. Now, what are some of the positive things we're seeing that this is having on mortgage interest rates?
Well, it's really interesting how it turned out, because I could have seen it going either way. I could have seen the institution of the tariffs, the delay of the tariffs, the announcement of changes to the tariffs. Any of this could have gone up or down, in my opinion. And I think what the market did was do what you do when you're playing a sport against somebody way better than you, and it's way too complicated. You simplify, right? So the market went back to basics, and the market said, okay, these tariffs are, if nothing else, at least a deficit reduction. If you think about that, ultimately a tariff is a tax. It's a tax that will fall on the American people. And that's going to be higher prices for the American people. It's a diffuse tax. So where do the remittances from that tax go? Where do they come from? Well, we pay a higher price to the people overseas, and then they pay the tariff back to the United States. There is a function of that where that is income, and that income reduces the deficit. It would be exactly the same as if we simply taxed everybody 10% of whatever they spent on goods this week, like a VAT in Europe, and said, we're going to tax you 10% of that, and then we're going to use that to pay down the deficit, right? So it's sort of a roundabout way of doing something like that with all the other effects that it has. So because of that, the market opened up today, and actually we are up 15 basis points as I sit here right now, which is really good for mortgage-backed securities. We're down 7 basis points on the yield on the 10-year Treasury. That is what you would expect if you saw yourself up 15 basis points the other way. This is an initial really good move for interest rates. And I've been saying, and Meghan's been saying for the last little while now, we're looking for a 2-year run down of interest rates. Every run starts with a gun. Not like that, but you know what I mean, the starting pistol, right? So yeah. Every run starts with a starting pistol. Unless you really want to go fast, then whatever. But this might be that. I don't know whether or not the bond market's looking at it and saying, look, deficit reduction is good for bonds. I think interest rates are going to go down in the future. That's a good bet. Let's go that way. And that could be enough to start the movement.
Absolutely. I don't think that we can hold these higher rates. I mean, the Fed doesn't want to pay high interest on their debt. So we're not going to hold these higher interest rates for long. The question then becomes, as I mentioned before, are we heading into a soft landing, recession, or more of a stagnation point in our economy? So we'll see what those things hold. Hopefully we are being optimistic and hoping for these rate reductions and a soft landing, although we might be saying that we've kind of missed that a little bit. And at which point, if unemployment is not going up, but inflation is going up, we're not going to have a choice but to lower interest rates, even given that unemployment is not up yet. So I don't know if you agree.
That's exactly the outcome. I mean, when things start to go wrong in the economy, the quickest lever the government has is the federal funds rate, and that kicks everything into gear. So hopefully we end up seeing that come to fruition sooner rather than later. I also know that based on what our internal people are saying, our secondary marketing department, that they've spoken with folks on the Fed, a couple of the Fed governors and a couple of their assistants, and that the Fed is looking ultimately to put the economy in a position where they can goose it through that kind of a stagnation, because that kind of a stagnation probably is coming. We avoided the big giant recession crash. Good, that's what the Fed is designed to do, and they did a fine job guiding us through that. You can't, however, avoid that and avoid the slowdown. You can't jump right back to productivity from where we are. There's going to be a period of time where there's going to be some stagnation. So, how do we deal with stagnation? We want to make sure things don't get too hot, things don't get too cold. We want to have the economy in a neutral place where we can rev it if we have to and break it if we have to. Now, the ideal place, given where the numbers are right now, according to the people smarter than me who have PhDs in this stuff, is 3.5% for the federal funds rate. Right now, we're above 5. So that's going to be a steady decline from the Fed's perspective to get us down to 3.5. And at that point, it's like my stepfather was a really, really good driver, and he could shift gears actually without using the clutch. He could just listen for when the speed of the transmission matched the speed of the engine, and he would just pull it into the next gear. It always, without grinding the transmission at all. It was incredible to watch. But to me, that's what the Fed's trying to do. They're trying to match the speed of the economy to the speed of the interest rate. And that's going to be at about 3.5%. From there, just a little bit of a push this way or that can guide us through the rough spots. So what that means is that in order to get us to where they want us to be, they have to lower rates. So things are starting to come together here to make it look like we are going to start that run that we've been talking about for a little while. Now, anything can happen, especially with tariffs. But that is the explanation of the market movement today.
Which is exciting. I mean, I think there's been a lot of fear, a lot of question marks around the repercussions of tariffs, if they're going to be positive, if they're going to be negative. Nobody
Mhm.
wants to pay more for anything. Nobody wants to have their eggs and their goods and their cars and everything go up in price, or their electricity.
Mhm.
But if we can have a silver lining through all of this and say, hey, but mortgage rates are going to start coming down, and there's a silver lining here where we're going to start seeing things moving in a direction that's positive, I'll take it. I'll take whatever I can get.
Yeah, no kidding. But it has been rather exciting. We have people calling in who are looking to put offers in. They're seeing new houses pop up on the market. When we get the numbers for what happens in April, I would be very surprised if the numbers in April aren't extremely positive. So it's looking like we're starting to get a little traction through this.
I am seeing within like our brokerage that we have more listings coming on, people signing on contracts, ready to list their house at the spring
Right.
market, which isn't uncommon. It's just a positive reaffirming, I'm losing my words here, but you know what I'm saying? It's good. Everyone's
Encouraging,
coming,
yeah.
hoping, encouraging. There we go. There's the word I'm looking for. It's very encouraging. I'm not seeing as many multifamily listings that I would like to see, because that's where I always have my eyes.
Yeah.
So not a whole lot there, which is interesting, but definitely seeing more single family homes starting to come on, townhomes. And if I have to be more specific when it comes to the smaller multi-unit space, it seems like specific pockets are having listings, which are kind of those pockets or those areas that generally always have listings. Maybe the demographics a little different. Maybe it's more inner city or whatever. Those listings tend
Right.
to be the last ones to fall off. And if
Okay.
you're looking in a more affluent area, there's not a lot, because people are being smart enough to know to hold, maybe,
Gotcha.
or maybe
Gotcha.
they're waiting for the spring to come into April, which
I
I'm
see.
hopeful that the spring market will bring some of those too.
So if you see the reverse of that, then you know that things are headed in the right direction.
Yes,
Got it. Okay.
absolutely,
That's
absolutely.
good
If
information.
I see
Awesome.
those things, it'll be very encouraging if I see more multifamilies in these other spaces coming on as well. Yeah.
So what do you need to tell your borrowers who are out there right now who are waiting and who have been on the sideline
I
for
would
your
say
buy?
I would say pay attention. Know what you're looking for. If you're looking for a single family or a townhome primary residence, you're not looking for the small multifamily unit, definitely get in contact with somebody, get a pre-approval, see what you can get approved for, and actively look, because there are listings in that space. There's plenty of them. There's definitely opportunity there. And I would get in ahead of it before you have even more competition coming in the spring. If you're somebody like me and you're only seeing certain listings in maybe areas that aren't your first choice, maybe they're your third choice locations, um, I think you'd have to use your own discretion,
Okay.
your own numbers. But for me, I'm going to hold. I'm going to wait and see if something better comes on, because I am optimistic about the economy, and I am optimistic that those listings are coming. They're just not here yet.
Got it. Awesome. All right. Thank you very much. I appreciate
Thank you. Thanks for
it.
coming. All right, everybody, have a great day.
All right. I'll see you later.